For the better part of 3 decades, we have been told that wealth is an abstraction. We've watched as value migrated from the physical gold bars in vaults and deeds to fertile land, into the ethereal lines of code, digital ledgers, and complex financial derivatives that exist only on a server. This was the era of pure software finance. It was a time of perceived limitless scalability, where growth was decoupled from the constraints of the physical world. But as we cross the threshold into the mid-2020s, that illusion is beginning to fracture. We are witnessing a quiet yet violent return to the physical. If you look closely at the market shifts between 2021 and 2024, you see it. The digital gold narrative is no longer enough. A private key is useless if the screen won't turn on. A ledger is irrelevant if the cooling fan stops spinning. We are entering a new epoch where the distinction between the financial system and the electrical grid is evaporating. This is not about the next speculative bubble. This is about the thermodynamic floor of value. For the long-term investor, the man who prioritizes the next 20 years over the next 20 days, the most significant hedge against institutional instability isn't just a digital asset. It is the copper, the turbines, and the sovereign power infrastructure that sustains it. Welcome to the horizon. Today, we analyze why the grid is becoming the new mint. To understand where we are going, we must acknowledge the end of the software-only era. Between 2010 and 2020, capital flooded into light assets, SaaS companies, social media platforms, and digital currencies that required very little in terms of physical overhead. This led to a sort of intellectual laziness in the markets. We forgot that every bit of data processed is a physical event occurring in a physical location. Starting around 2021, the world hit a wall. Supply chain disruptions were the first tremor, but the second was more profound. The realization that our digital ambitions have outpaced our electrical reality. The surge in demand for high-performance computing, driven first by the maturation of decentralized networks and then by the explosion of generative AI, has turned energy from a background utility into the primary constraint of capital. We have shifted from a world of speculative code to a world of physical constraints. If the last 20 years were about who could write the best algorithm, the next 20 will be about who owns the electrons required to run them. We are moving past digital gold toward what I call thermodynamic sovereignty. History tells us that money has always been a proxy for energy. In the era of the gold standard, gold was hard, not just because it was rare, but because it represented a massive expenditure of human and mechanical energy to extract, refine, and transport. It was a physical proof of work. When we moved to fiat currency, we transitioned to soft money, a system backed by debt, which is essentially a claim on future energy. Civilization-level wealth has never been created by clever accounting. It has always been a byproduct of energy surplus. The Industrial Revolution wasn't a financial miracle. It was a coal miracle. The post-war boom wasn't just Bretton Woods. It was an oil miracle. Today, we are seeing the birth of energy-backed money in its most literal form. We are moving toward a thermodynamic standard where the value of a currency or an asset is anchored to the kilowatt-hour. This is an essential shift for the sober investor to understand. As institutional trust in fiat wanes, capital will seek assets that have a direct, unbreakable link to the laws of physics. You cannot print a megawatt. You cannot quantitatively ease a power plant into existence. This physical scarcity is the new bedrock of value. The mechanism driving this merger is the convergence of artificial intelligence and proof-of-work mining. At first glance, they seem like disparate industries. One is a decentralized ledger. The other is a centralized cognitive engine. But from the perspective of the power grid, they are identical. They are both energy-to-value converters. Large language models and Bitcoin mining rigs both perform the same fundamental task. They ingest raw electricity and output a digital commodity that the market prizes, intelligence in the case of AI, and truth in the case of Bitcoin. This creates a global floor price for the kilowatt hour. If a power producer can sell their electricity to a local data center to mint a digital asset or train a model for a higher margin than selling it to the residential grid, the price of energy will adjust globally. This is compute energy arbitrage. We are no longer just trading stocks or bonds. We are trading the efficiency with which we can transform heat into information. For the man over 40 looking to preserve his legacy, understanding this convergence is critical. You are no longer investing in a tech company. You are investing in a vertically integrated energy compute stack. Now, we must look at the sobering reality of our current situation: the infrastructure deficit. In the West, specifically in North America and Europe, we are operating on a grid that was largely designed in the mid-20th century. It was built for a world of predictable, centralized loads, not for the volatile, massive demands of the digital age. We are facing an energy compute bottleneck. In many jurisdictions, the wait time to connect a new industrial-scale load to the grid is now measured in years, sometimes decades. This scarcity has transformed the grid itself into a high barrier to entry asset class. If you own a substation or a behind-the-meter energy source, or a permitted data center site with power secured, you own something far more valuable than pure software. You own a choke point in the global economy. This is why we are seeing institutional giants, BlackRock, Vanguard, and sovereign wealth funds quietly pivot into energy infrastructure. They aren't buying the apps, they are buying the plumbing. They realize that in a world of infinite digital noise, the physical ability to process that noise is the only true scarcity remaining. For the investor who has spent decades navigating the traditional markets, this shift requires a recalibration of what constitutes a hard asset. We used to think of real estate as the ultimate defensive play. But real estate without reliable, affordable power is just a liability. The new hard assets are those that sit at the intersection of energy density and compute capacity. Think of nuclear power, grid-scale storage, and decentralized energy production. These are not speculative plays. They are the structural requirements for the next 20 years of human progress. When we look at the energy-money merger, we aren't looking for a quick exit. We are looking for the steady, reliable flow of electrons that will underpin every financial transaction of the future. The mint of the future isn't a building in Washington, D.C. or a central bank in Frankfurt. It is the turbine and the transformer. In our next section, we will dive deeper into how this arbitrage works and how the sovereign power producer is rewriting the rules of the global market. To understand the new era of the sovereign power producer, we must first look at the structural inefficiency of our current electrical grid. For decades, utilities have struggled with the duck curve, the massive surplus of energy generated during the day that vanishes the moment the sun sets. Historically, this surplus was wasted or sold at negative prices. But we are witnessing the birth of compute energy arbitrage. By placing high-density compute, whether it's Bitcoin mining rigs or AI inference clusters, directly behind the meter at the source of production, we are no longer just generating power, we are monetizing the physics of the grid itself. These facilities act as interruptible loads. They consume the surplus when it's cheap and plentiful, and switch off instantly when the grid faces a peak. For the long-term investor, this is a fundamental shift. The power plant is no longer just a utility. It is a financial mint. It converts excess electrons into globally liquid digital assets or high-margin compute cycles, creating a floor price for energy that never existed before. This isn't speculative. It's an optimization of the most important resource in the history of civilization. For the better part of the last century, the US dollar's hegemony was underpinned by its relationship with oil, the petrodollar system. But as we move into a world defined by silicon and software, energy sovereignty is becoming the new reserve currency. We are seeing a quiet but profound geopolitical pivot. Nations are realizing that hoarding paper currency or even digital ledgers is insufficient if they do not control the physical infrastructure that secures them. From the expansion of nuclear capacity in the UAE to the build-out of massive hydropower data clusters in the Nordics, the goal is no longer just energy independence, but compute sovereignty. If you control the energy and the hardware that processes the world's intelligence and financial transactions, you possess a level of leverage that no central bank can manufacture. For the man over 40 who has watched the steady erosion of institutional trust, this is the signal through the noise. The next global reserve asset isn't just a currency, it is the localized, energy-dense compute cluster. It is a hedge against the instability of fiat systems, anchored in the immutable laws of thermodynamics. How does this translate into a portfolio? For the last 30 years, wealth was often synonymous with pure software, capital-light businesses that lived in the cloud. We are now entering the era of hard energy assets. The investor looking at the next 2 decades must consider the verticalization of the data center. We are moving away from paper assets and toward the physical bedrock. This means looking at companies and structures that own the entire stack, the land, the power generation, specifically nuclear and grid-scale storage, and the specialized enclosures for high-density compute. This is the energy-money merger in practice. Nuclear energy, once sidelined, is returning as the ultimate institutional-grade asset due to its unmatched energy density and 24/7 reliability. When we analyze the capital expenditure trends, the shift is clear. The smartest money is no longer just buying the apps. It is buying the turbines and the transformers. In a world of digital abundance and software replication, scarcity has migrated back to the physical world. Your long-term hedge is the infrastructure that makes the digital world possible. It is the bridge between the byte and the atom. We must be intellectually honest about what we are witnessing. The convergence of energy and money is not a crypto trend. It is a structural evolution of how humanity accounts for value. Every monetary system in history has eventually failed when it became too soft, when the cost to produce a unit of currency fell to near zero. By tying our financial systems to the energy grid, We are reintroducing a thermodynamic floor to value. You cannot print a kilowatt hour. You cannot manifest a megawatt through a policy change. It must be generated, captured, and directed. This provides a sober reality check for the global markets. As AI demands more power and decentralized networks require more security, the kilowatt hour becomes the universal unit of account. For the long-term investor, this is reassuring. It means that despite the volatility of markets and the noise of the 24-hour news cycle, the fundamental value of your holdings is tied to the most basic requirement of modern life: the steady flow of electrons. As we look toward the horizon, the message is clear. The era of pure software finance is closing. The era of the energy-money merger has begun. For the man who has spent a lifetime building and protecting his capital, the strategy for the next 20 years requires a return to the physical. Don't be distracted by the latest speculative bubble. Look instead at the grid. Look at the power plants. Look at the infrastructure that fuels the intelligence of tomorrow. The future of money isn't just a flickering number on a screen. It is a turbine turning in the wind, a reactor splitting an atom, and a transformer humming in the night. It is the physical manifestation of work, and in that, there is a sober, lasting stability. I'm the horizon. Thank you for your time and for looking further than most.